Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with John Barr of Needham Funds.
John is a long-term, bottom-up investor looking for great high-quality companies before they become high-quality companies. It's something I know you'll be very interested to hear about. So let's talk with John Barr. Let's do it right now. John, welcome to the show. Thanks for being here.
Dan, great to be back with you.
All right. I think you're a new. I was looking through the archives, and you seem to be a new guest to the show. I like to start off in a certain way with new guests, and especially someone in your business at Needham. So the basic question then, John, is if you and I were sitting at a bar and ran into each other and the subject of investing came up, and I said, "Oh, what kind of an investor are you?" What would be your answer to that?
A patient, long-term investor who looks to take advantage of compounding. And I term my investment process from hidden to quality compounders. It's really defined by the hidden to quality compounders.
I see. Hidden to quality, so that you find them when they're hidden and hopefully they become quality. Is that correct?
Exactly right. Find them when they're hidden, hold them through the transition, and then hold them longer when they become quality.
All right. Now, I talked with someone from Needham many, many years ago. Would you say that your perspective is different from the rest of the folks at Needham, or is the company generally, are you kind of all generally in the bucket that you've described for yourself?
Well, at Needham Funds, we are part of the Needham Group. And the Needham Funds, we have 3 mutual funds that invest in small and mid-cap growth equities.
Okay.
And the Needham Group, the other side of the firm, is investment banking, research, institutional sales, and trading, and investment banking for small and mid-cap companies, and so growth companies. And the firm was started in 1985, and we launched the first mutual fund in 1996. So we've been around for a long time doing this. And on our side, the mutual fund side, we're a small team. There are 2 portfolio managers, and as I said, there are three funds. And I manage the Needham Aggressive Growth Fund, which is categorized as small cap growth by Morningstar and Lipper.
Aggressive growth. That sounds interesting to me because the last, several years, growth has been on everyone's mind. That's what people wanted to go after. From the up and coming growers all the way up to the solid mega cap growers. When did the Aggressive Growth Fund start?
Great question. I see the the curiosity in this line of questioning. 2001.
Oh.
So the fund was launched in 2001. So you can imagine that an aggressive growth fund in 2001 was quite appropriate.
Yeah.
But as a firm and as fund managers, we're quite conservative, and so as any a partnership that's been around for almost 40 years, you would expect. When we talk about the criteria that I look for, margin of safety is a key part of that. So valuation sensitivity is important. So I guess in the old days you would have called it growth at a reasonable price, but I think it's more nuanced than that now. And
Yeah, it's been quite a while, hasn't it, since the terms growth and value kind of identified two totally separate buckets, right? It used to be value was that what we would now call cigar butt kind of bucket, and then, growth was what, growing companies. But it's not, I mean, even like Warren Buffett, among other people, I suppose, has probably done more to just sort of disabuse us of that notion. And growth and value, they're joined at the hip in most folks' mind, aren't they?
Right. And in my case, I'm looking for companies that are reasonably valued today, but with very low turnover. And last quarter, we were 7% annualized. So looking at a 14-year holding period, we really are looking for businesses that are going to become the quality compounders that are great. And you can't do that just looking in the value bucket. You also certainly can't do it going for high value growth companies. So
Right.
we're growth investors, but with a different angle on it.
Yeah, John,
Right.
that's one of the things I
Interesting.
read one of your recent research reports, and you highlighted your super seven and growth. Now that is not the magnificent seven, right? That is we're talking about not complete opposite, but you can describe how your approach is not that. When a casual person thinks growth or high growth or whatever, that's not
Yeah, I
what
was
you're.
thinking I would call them, Corey, I was thinking I'd call them the Needham Aggressive Growth Mag 7, but then we thought we don't want any association with
Right.
that, so
Yeah.
we call them the Super 7.
Yeah.
Uh, and yeah, so these are, so let me just step back a little bit. So my mission is to create wealth for long-term investors. And as of January 1, this is the 15th anniversary of my managing the fund. So now
Oh,
we've got
congrats.
a
Nice.
15-year record. And over that time frame, we've compounded at over 14% a year. And the Needham, or the Russell 2000 growth has compounded at around 10%. That 4% per year compounded, if you put $10,000 with us into the fund, the Needham Aggressive Growth Fund at the beginning, you'd have approximately $75,000 today. And if you had put it into the Russell 2000 growth, you'd have about $45,000. So that just shows the power of compounding at slightly higher rates.
Hmm.
If you had been in treasuries, you would have earned in 15-year treasuries and reinvested every year at the same rate, 3.7%. You would have less than half of what you had if you just invested in the index. So appropriate investing in being able to beat the market really can create wealth over the long term. So that's our mission. And I found, and in that research paper, which we called The Power of Long-Term Leadership, the Needham Aggressive Growth Fund's Super 7, there's 7 companies that we invested in over this time horizon that contributed over half of our alpha. And the thing that I was looking for here, so I look in a hidden compounder, there are 4 criteria that we look for. The first is that the company has an established business, but is investing in something new that the market doesn't yet understand. So we're looking for small caps that have a stable business that are investing in something new. That also helps us protect on the downside because it has that established or legacy business. And if the new thing doesn't pan out, we have downside protection. But in these cases, these Super 7 and about 10 others, the new thing really did pan out. So that new business is criteria 1. Criteria 2 is great management. And everybody says they invest in great managers. And to me, I did the shortcut of founders, family, or long tenured. Um, and and then this growth factor paper that I wrote highlighted 7 of those that are in those 3 categories, and they're great stock stories to tell. And then the third criteria is margin of safety valuation, and the fourth is they're in a big market. They're addressing a potentially big market, because if we're going to invest for 10 to 15 years, company needs to get a lot bigger to produce a market-beating return.
Would you care to share one of those names with us and tell our listeners just sort of how it evolved and the new thing they did in this stable business and so forth?
Yes. Well, why don't we start with 2 of the family-run businesses? And number 1 is LeMaitre Vascular, and the symbol's LMAT.
Okay.
This emerged, we bought it in 2008, so my predecessor actually bought it. And it was an IPO the year or 2 before. The company makes vascular devices, and so sell to vascular surgeons. And they are expert in developing and acquiring niche products that they can put through their sales force. When we bought it, it was a sub 100 million market cap, and was down from its IPO. Stock was at $3 or $4 and closed the year at 90 or so. So this is a 20 bagger for us, and it has been run by the son of the founder, George LeMaitre, founder George LeMaitre Sr., doctor, and they have just done an incredible job of getting strong returns, expanding margins, and growing the top line over this 16 years that we've owned the company. So this is clearly a quality compounder. It's no longer hidden. The new investments have paid off, and it has been a great returner. So as CEO, George has generated 3,200% return, for 32x since the day we bought, versus about 1/10 of that for the market. So shows the power of being right and great management. A second one, and had no research coverage at the beginning. Now it has some. Oil-Dri Corporation of America is the second one I'll highlight. We bought this in 2012. It is currently about a 700 million market cap, and it was a couple hundred when we bought it. Run by the 3rd generation, so Dan Jaffe is grandson of the founder, and it adds value to absorbent materials, so specialty clays, and it started as clay absorbents around a factory, and in World War II, and then today they have expanded into cat litter, including lightweight cat litter, where they are one of the leaders, and then there's also some very interesting specialty materials applications in broader industry. And the management doesn't meet with the street. There's no coverage. They do a quarterly conference call, and that's about it. He was told long ago by one of his board members that put up the results and the stock will take care of itself. And it has also significantly outperformed, and I think still is very attractively valued at around 12 times earnings.
Is that forward earnings?
Yes. Yeah.
Wow.
Yeah.
I mean,
And that's
It's
those are my projections. So there
sure.
are no street projections. So
Right.
I could very well be wrong.
But it even, I mean, the sort of headline PE, if you just look at Yahoo Finance or something, is like 14 and a half trailing,
Yeah, trailing, right?
which is not, I mean, at this moment for a high quality company is not expensive at all. You know,
Right,
right now you could easily for quality right now, you could easily pay double that. Easily, right?
right,
So that's pretty neat.
exactly.
You've put something on my radar screen here. That's pretty cool. Um, so what maybe so in the second case, I'm sorry, in the second case, oil dry, we had that clay business, and then you told us the new stuff. I'm sorry, can you take me back and just remind me what was the established thing and the new thing at LeMaitre?
Oh, the established thing were the first products that they launched. The first one being called a valvulatone, which
Okay,
Dr. LeMaitre invented, and it was for reversing the blood flow in vascular surgery in the legs.
I see.
So getting better blood flow down to the peripheries in the feet. And then they have done a series, probably introduced another 20 products, 30 products. Uh, and, uh, and there is a distribution. Some of them work quite well, some of them don't. But in aggregate, they produce those strong results.
All right. And I noticed, I just was reading blurbs, as soon as you identified which companies you were talking about, and they were talking about these cryo human tissue grafts, which sounds to me like a highly, highly technical thing that, I mean, you tell me, it doesn't sound like something that's really easy to imitate.
Right. I think the competitive advantage comes from just more the niche
Hmm.
that these are rather than the technology
Okay,
that is going into them.
right.
Uh, and they are from from 15 to $60 million businesses. So they're big enough that they can take advantage of their international distribution and regulation. And regulation in Europe in particular is a really big deal for medical devices.
Yeah.
And it's a barrier to entry for small companies. And then the big companies, these niche products are too small to worry about. So they really have a unique niche.
Yeah, that's one of the things that strikes me from all these businesses, and we could talk about a lot of different things with this approach, but like I assume that the vascular company, like they were pioneering right at the time, and I assume they didn't really have a lot of. You could tell me, did they have a lot of competition at the beginning, or were they just the first in, and then with that, like, how do you end up spotting these companies? Because there's a lot of companies out there, and like you said, I think a lot of them were trading at like single digit, in dollars when you guys bought them. So how do you end up finding these companies and that process too?
Well, you're right about the lack of competition at the beginning. He was the first. And Dr. LeMaitre started in 1992, and then Sun took over to commercialize the business about 5 years later. So it was really a science project at the beginning, and then the Sun took over and really put the commercial aspects around it. Where do we find it? So being part of Needham is focused on growth companies. Needham hosts a conference every year, the Needham Growth Conference, which kicks off in January. And there are about 400 companies that present there. And I will see, and we're a buy side, just like anyone else is, but I will see 10 companies a day as will my colleagues. So we'll see a number of companies that are new. We'll see a number of companies that we own. And I also like to see private companies, because that gives us a good sense for what's coming in the public markets later, and also gives you a good sense of trends. And then, just having been at this for so long, we generally know of just about everything. And when something comes on the radar screen that we haven't seen that seems to fit the criteria, we're able to do a pretty quick deep dive.
Makes sense. And one of those criteria, you talk about the family owned or family run businesses. Why, if you could explain to people, why do you like that type of management so much? What benefits does it have? I think in the case of the oil dry one, that's third generation, right? So like we're going, just why do you like those type of that structure so much?
Yeah, they tend to think longer term. And they are also able to make investments that may not pay off in the short term. And I'll cite, Oil Dry made significant investments in animal health. So using these specialty clays for gut health in swine and poultry, with the objective of replacing antibiotics in the food system. And they invested for since we owned it, so 10 years in this, and it's just started to pay off in the last couple of years as a family run and controlled. So family controls the shareholder vote here. They're able to look beyond short-term shareholder pressures. And I might cite another of the companies that we own, which is Vicor, which is a power conversion company, and the symbol's VICR. And this is in the founder bucket in our Super 7. And their established business was power conversion devices that were used broadly in industry. And for 20 years, they invested in a modular shrunk version of it, and only started to get payoffs after about 15 years of those investments. And again, it's a controlled vote, dual class share structure with the founder still as CEO. So another long-term thinking CEO.
I have a question that's it's not completely off topic, but I'm curious. Why doesn't Needham? It sounds like Needham doesn't have the typical institutional prohibition against buying stocks under $10 a share, which never made any sense to me, but it is what it is. It's pretty widespread. Why don't you guys have that?
I mean, just to look at where we came from. So we launched these funds in '96, and we launched my fund in '01, and then our third fund in '02. And they're predominantly friends, family, and employees of Needham and Company.
I see.
And our mission is to create wealth for long-term investors. So the funds currently have a little over $1 billion in assets in the three funds. So we're out to create wealth. We're not part of a big fund complex. It's a different business model.
That's a good answer. I thought it was going to be as simple as, well, you can't do this without buying the single digit, right? You can't find those $100 million bets. I mean,
It's true. A lot of these Super 7, and then I added Appendix A is Super 7 plus 10.
Okay.
So these are the 17 that contributed over 80%. And just eyeballing it, half of them were under $5 to start.
Right. So 17 out of how many would, I realize it's over a long period of time, you cut a lot of losers, whatever. 17 out of how many? I'm just curious if you have a
Yeah.
ballpark.
So just maybe I can just describe that pipeline. So about half of the hidden compounders make it to the transition,
Okay.
and then less than half of those, maybe 25%, make it to quality, and then you come up with 17 at the end. It's less than 10%
Yeah.
of the total. So with our low turnover, there are probably a couple hundred companies that have been in the portfolio over the 15 years.
It's so interesting, isn't it, that that phenomenon of, a few names getting all the return, it goes through every strategy. VC, venture capital, a friend of ours runs large portfolio of, maybe 100 at any given time, 100 small cap or nano cap, tiny exploration mining stocks. What you're doing is completely different from either of those. It's very, very interesting how it is, and it is kind of a mining operation, isn't it? You remove a large quantity of earth, many names in the pipeline, and then you get 17 grams of gold in the end of it. It's pretty neat. And Warren Buffett has said the same thing about his portfolio. All the result, most of the result came from, I think it was 14 or 15 names, over decades and decades.
Yeah. So the inspiration, the insight to me, having been around this business for a long time, was really to hold on to them when they're in that quality stage.
Yes, yes.
Just
You
we we start very small, so 30 to 50 basis points. So if they go wrong, our downside loss is limited. And then we add when they start to show the progress in the late hidden through the transition. And then once they're quality, as I say, even the quants can find them.
Yeah.
So, but the particular insight was hold on. And this is something else that's a little different than you'd find at a bigger, more institutional money manager, is that we're a small cap fund, and that's important. But some of these companies grow to be into the mid cap or even large cap range with this success over time.
Yeah.
And I'm not forced to sell. So
this is really, I'm sorry. This is really interesting to me. I'll tell you why. Because mostly successful investors, they really do one thing, right? They do one thing. They don't do 10 different strategies. They have their one thing and they're great at it. You're really good at a couple things here, aren't you? You find the up and comers, right? When they're very small and maybe they have their established business. But an established business with making some investments in a new thing, that's not necessarily, as you've pointed out, going to turn into quality. And then you have to hold them. Then you become a quality investor somewhere, hopefully, right? Fingers crossed along the way. That's pretty impressive. That is
right.
Yeah.
You've broken it into pieces. There are a couple of things that we have to do.
You
One
need
is
two big skills there.
And then you've got to become a larger cap hold on investor too.
How do you do that? Do you have separate teams or something? Say you're the quality guys. Okay, these names have made it into quality. We're going to go back to searching for the smaller stuff that we hope will turn into that.
Well, our team is there are two of us as portfolio managers, and then the rest of the team is 4 people, and that includes everything.
Wow.
So you're pretty well looking at the team. But no, the other we are a great team, but we are a small team.
Wow.
But no, a lot of the effort goes into the finding the new, and then lots of effort going into deciding which of the hidden compounders are going to get the new capital, and where are we investing to really grow those from the 50 basis points up to the 200 basis points. Once they hit quality, we don't add more to those positions. We will trim when they hit 10% of the portfolio, rarely on valuation. And so we're not the best seller. We're not picking that top. But this leads to another study that I did, which was kind of interesting, that all of these have had over 50% drawdowns or sell-offs in the periods that we've owned them. Every single one of them. And the better course of action was to hold on. And of course, our thesis has to be on track. But every stock sold off a lot.
You know,
that turned into a winner.
That's interesting to me because in our business, like if you hold too many stocks that are down 50%, our readers will crucify us. They will absolutely not tolerate it. But and I am not a much bigger deal in our industry because I've occasionally held them, you know, and the extent to which I didn't was a mistake. I wanted to underscore for our readers back when you were talking about holding, and now you're talking about holding again and not worrying about being a great seller. I can't underscore that enough for our listener. The two biggest mistakes I've made in about 30 years here are, buying not so great. I would say buying garbage, but let's just say buying not so great companies and hanging on way too long, even if it's just a year or two, and then buying really high quality companies that were doing just fine and selling them because the stock price was down a bit. Big mistakes. If a company's still a great company, there's no reason to do anything. Let the market do what it's going to do, and it'll reward the quality over time. Which you've managed to deliver that service over quite an extensive period of time, which is pretty impressive. And the dual job is going to be, that's where, long after we hit stop on this recording, I'm going to be thinking about this, and I'm going to be wanting to learn even more about Needham, than we did before we talked to you, because that is so unusual. People talk about this, don't they, John? A lot of people talk about doing this. They say, we want to find the great compounders before they're great compounders, but you have a track record of doing it. And I don't think there are a lot of people who can demonstrate that. It's hard.
I think looking in the small cap bucket gives us an advantage.
Mm-hmm.
And I think being able to hold them gives us another advantage. And it all goes back to our mission, which is to create wealth for long-term investors.
Right. Let me ask you a question real quick. How many names, like as I look at the top 10 of the aggressive growth, Yahoo says it's 32% for the top 10 names. How many names total are in that right now?
There are a little over 80.
80.
80, which is a high number for me right now. We have typically been more in the 60 to 70 range.
Still a goodly number, and something that I think an individual would have quite a bit of time keeping up with.
Right.
Yes.
You need a team of 6 for that. So I think that's important too, because we talked about the big pipeline and then 17 super stocks that made it, and so at any given time you're holding 60, 70, 80 names. I just want to give the listener an idea of what's required here, because a lot I've known small cap managers who were focused. They said, well, we run a concentrated portfolio, and I'm like, and they want to compound over time, and I just think my examples of VC plus the mining guy plus what you do, it's all, there's a thread running through here. You got to hold a lot of names because you can never be 100% sure which one of them is going to be the one of those 17, right? You don't know that ahead of time, right?
Right. And as I look back on my writings or interviews and the companies I featured, a lot of them didn't work. They were in that 50% that were were not the ones. So you just don't know which of them, which is why we like to put the capital to work once they've started to show that they're entering the transition or entering the quality phases.
Right.
Yeah. A lot of lessons here.
That's a key moment.
Management.
Yeah.
Yeah. Like just portfolio management in general for people. I mean, how do you know when do you just, or talking about, obviously you want to hold long-term winners. How do you know the opposite when you're getting rid of something? I mean, what do you think through to that point, and how much do you have to see before you do that?
So look at the opposite of the criteria. So a big one is management change. Mm-hmm. So if you had either family, well, anytime there's a CEO change, we look at it quite carefully. And we're not keen on the hired gun who's got great experience. We really like somebody who's grown up inside the company or founder or family. So management change is one. And then second is just realizing that the new thing is not going to play out. And then we'll figure what we think it's worth and look to exit. But they're small caps, and in many cases, we are the top active manager that holds these. So on the cap table, we're pretty far up there. So we're patient sellers as well.
Gotcha. Patience.
So patient buyers, patient holders, and patient sellers.
Patience. It's so hard. People just want to mess with it. People just want to do something. They want action in their portfolio. And the funny thing is, the action tends to, one of Charlie Munger's great quotes is, the best thing you can do is not interrupt the compounding unnecessarily, right? That's the key. And everybody wants to interrupt it. Everybody, you sell out of these names because you're bored with them, and you've just, pissed away 10 years of wealth creation. But you don't see it because it's not there yet. It's in the future. It's hard. It's emotionally very hard to do what you do.
You on that score, I did a write-up about a year ago in our Growth Factor and featured some companies that had worked, but then an example of exactly what you've just described, Dan, was Dick's Sporting Goods. So we had bought it well in 2009, and then got concerned that Amazon was going to take over the sporting goods category, even though we liked Dick's approach to e-commerce.
Yeah.
And so the stock had pulled back, but then it rallied from 25 to 30, and we got a good sale at 30, and then it may have fallen after that. Well, take a look at Dick's right now.
Yeah.
And you will realize that the risk reward was just completely off.
207.
There you
the
go.
Quote.
So my sale at 30 in 2017 or so, not so good.
Right. It's the exact mistake we just talked about. I've made it a million times. Even you guys make it, and you're good at this. So it's really hard. We covered Dick's in our newsletter, Extreme Value. Really good,
well done.
Good quality company,
Yep.
And the thing was, like, just bricks and mortar in general, retail is like, I think people consider that really, really difficult now, which, it's not wrong, but doesn't mean everything should be avoided.
Yeah, and they just did a great job of combining the e-commerce with the bricks and mortar.
And the bricks and mortar is beautiful when you go in there. I mean, it's gorgeous. The rock wall and just the whole place is beautiful. And that, you have like the little shoe area is really cool. The whole thing is really well done. And you're right. Yeah. E-commerce, you just go in line and drive right up to the front door and away you go.
So Dick's is a good example of leaving on the table and not having patience. Although we had great reasons. I mean, it seemed like Amazon was really going to come for that business.
Yeah, who could fault anybody for being afraid of Amazon? I mean, you know, not being afraid of Amazon was a mistake far more often than being afraid
That's right.
of them. So
It's true.
you know, we can let that one slide for sure. But overall, the result you guys generated is so good, right? Um, and it's incredible too. You can get a fantastic result making errors that take away 10 years of great compounding. Uh, it's all about, and we always get to this point with the long-term sort of bottom-up fundamental people. You just got to keep working that process, don't you? Like, you can't doubt the process when you know it works.
Right. And I've found it's also keep looking to understand yourself and your strengths. And as it's another Munger quote of staying in your lane.
Mm-hmm.
And just only do what you know. And if you have to ask the question, you don't know. So
that's well said. Yeah. Do what you know. If you have to ask, you don't know. It reminds me of something. I heard an anecdote about Mozart once where someone was talking about how he started writing symphonies at some ridiculous age, like 7 years old or something like that. And I don't know the exact age, but it was something like that. And, um, they said, wow, that is so incredible. And at the time, it was a conversation, as I recall, between a teacher and a student. This is many years ago, so forgive me for the vagueness of it, but it was between a teacher and a student. And ultimately, the teacher wound up saying to the student who was asking them about how to write symphonies, and the teacher in the end said, it was in a master class, I remember. And the teacher said, well, Mozart didn't ask a teacher how to write. He wasn't asking anybody how to do it, right? He found his lane and he stepped on the gas pedal and stayed in it, and that was that. And you guys are, it's about finding your lane, and if you have to ask, you don't know. Mozart didn't have to ask. You're not asking. You're just doing it. And that gets into a topic. I'm glad you sort of broached this. You have to know yourself and learn yourself. We've written about this. I've written about it a few times, that investing is such a personal thing. People want to ask people like us, what should I do? And so much depends on them, their risk tolerance and their goals, and just their income and their assets and where they are and what they want to do. It's a very personal thing, and their personality. Can you really hold on for 15 years? Most people, a friend of mine says they can't hold over a long weekend. So you got to know yourself, don't you? And you found a team of people who kind of do that well. All this stuff is very rare. People think the stock market is easy, but it's not about the market. It's about being a good investor, and it's very rare, isn't it? It's a rare combination of traits.
right. And it's important, yeah, to know yourself and to and then figure out how that can apply in these crazy markets to produce wealth. And anything that's short term, good luck. It may work, may not work, but the market does give you opportunities if you take advantage of time arbitrage to outperform and create wealth. And yeah.
So I'm glad you said
that's what I found.
I'm glad you said the words "these crazy markets," because it's a typical thing. Yet another mistake I've made. It's a typical thing to take a change of in the White House, from whether it's from Democrat to Republican, or just this president to that new president for whatever reason. And you often hear people say things like, if so and so gets elected, I'm selling it and I'm moving out of the country, et cetera, et cetera. And it's been a consistent error. If you just look back over the last 20 years, you should have just held. You shouldn't have worried about it at all. And it always seems urgent at the time. It seems urgent to many people right now to be careful. What is Trump doing? What are what's the implication of tariff policy is a big one, et cetera. What's the implication of trying to make the government more efficient? What are all the implications of that? But to be a bottom up compounder over a long period of time, you largely have to ignore all this, allegedly important macro stuff. Do you not?
Oh boy, right on, Dan. I'll go to Peter Lynch in 1993. You can find good reasons to scuttle your equities in every morning paper and on every broadcast of the nightly news. Now, the morning paper and the nightly news are no longer a thing, but you can still find even more
24
reasons
hours a
to
day.
scuttle
Yeah,
your equities
Yeah.
on X and on the internet every day. As I think back over the last 15 years just on this fund, there was always something that seemed like it was just the most pressing geopolitical matter. And then you think back even to like a year or two ago, and you hardly remember what they were. I think there are a couple of things that are important. Number one, you do have to be an optimist to do this. You have to think that things are going to work out and that this is not the one that's the end of the United States or civilization. So you've got to be an optimist. And I think you have to look out X number of years and say things are going to be okay. And no matter what happens in the next 3, 6, 9, 12 months, if you take those views, if you're an optimist and you look out a period of time, and then you overlay what you think your specific companies are doing and can do in that time frame. Oh, that's been the secret for me.
Right.
I would think that the companies you're focused on too are like they're thinking the same way, right? Like they don't want to be succumb to like whatever geopolitical pressures that may come up too. So they're trying to. I mean, they would
Right.
they want to be immune to that too at some level, right?
Right.
Maybe.
We have smart actor CEOs who are going to figure out how to navigate their way through whatever the geopolitical situation is.
Right. And when the situation changes,
value for their...
Go ahead. Sorry. Yeah. So and when the situation changes, it tends to be, okay, now here's a new regime and the change is done and businesses do what? They dynamically, figure it out and change and innovate and they figure it out and continue to operate. So it pays to be an optimist, which is
now we also have had tailwinds forever of monetary inflation,
right.
And with a lot of debt and unfunded liabilities, it is kind of the only way forward.
Mm-hmm.
So that's kind of my shortcut for macro, and you don't know what may happen in short term, but
right. That is a good shortcut, isn't it? Because in the end, throughout all history, from the very first government ever, we know that they're going to sacrifice the currency to save the banks and the bond markets, right? That's just the way that's the way it's going to be. And if you own a productive asset that's getting 20, 30, 50% on capital or something, these huge high numbers that some of these businesses can do, you're not going to suffer. You're going to do just fine.
Right.
It's
so monetary debasement is or currency debasement has been time immemorial.
Yep.
And these companies can adapt and produce returns to at least preserve value. And if you can outperform, you can stay ahead of the curve with equities.
Right.
Can't do it with bonds.
No, which is, not to say that owning bonds is a bad thing, whatever. People get to different points in their lives when they want to preserve more than they want to grow and so forth. But if you want to grow big numbers over long periods of time, the folks within the sound of our voice are not going to do it by, you know, taking flyers on options or futures or any kind of crazy, risky, highly difficult thing like that. It's so much simpler for them to just buy good quality companies and hold them for as long as possible. Like that's the most direct sort of, in my mind, simple but not easy path to really much greater wealth than most folks are going to find any other way. But it's really hard.
Go to another Peter Lynch, One Up on Wall Street, which
Yeah.
was invest in things that you know,
Yeah.
and you can have an edge on the market. And
Right.
at its essence, that's what we try to do at Needham Funds.
Yeah. Circle of competence. It doesn't matter how big your circle of competence is, but man, you got to respect the boundaries, right? You don't have to know a lot, but you better not go outside that circle. And of course, you can work to expand the circle over time, can't you? You guys must have had to do that, right?
Right, and always looking into new areas. I mean, so I described our process, but tactically, where have we invested? It's been in the picks and shovels of infrastructure broadly defined, and that does include some concrete and engineering and construction, but it also includes technology infrastructure, and that's data centers and semiconductor manufacturing. And we've been on this for 15 years, and then came AI, which exploded the interest in these areas. But infrastructure broadly defined is really where we've been focused. And we then expand our knowledge and look into new areas. And in the last few years, one of those new areas has been defense. So looking at defense as a critical part of infrastructure. So just an example.
Did you buy any of those zippy European defense stocks? I looked at a couple of those. Rheinmetall has had quite a hell of an incredible run.
Boy, it sure has. It sure has. But no, we're focused on North American equities for the most part, like 95%. Mm-hmm. So we did invest in Huntington Ingalls, which has Newport News shipyards. They're the sole maker of the nuclear carriers, and I have a duopoly in nuclear subs, and then they also have the Pascagoula shipyards, which does other naval vessels. And as shipbuilding is a major problem / opportunity for the country. China was 230 times the shipbuilding capacity of the United States, and this needs to be addressed both from a commercial maritime but also a military. And Huntington Ingalls is one of the premier shipbuilders in the U.S. So just an example of what you pointed out. This is a new area for us in the last few years.
230 times is the number that will stick in my head from that bit of conversation. Wow, I did not know it was like that. I knew it was a lot more, but I hadn't heard that number. It's a lot of ships, and it's a lot of difference, right? It's a lot of potential, investment. And if that's made, wow, if anything approaching that investment is made, that's an enormous amount of money. We're not talking about starting a software company here, right? I mean, the facilities are massive. The equipment is massive. The capital investment.
But we had it 40 years ago and just gave it away. So where have we put money more recently? And it is along the lines of this theme, and it is in the skilled labor side. And we have invested last year, 3 of the new companies were Universal Technical Institute, UTI, and Lincoln Educational, Lincoln Tech, symbols LINC. Mm-hmm. And these are the 2 leading skilled labor schools. And it's just a drop in the bucket. So they do welding and HVAC and automotive, and we have a huge deficit in skilled labor as the workforce retires, and we need them for shipbuilding. We need them for everything, and there's strong demand for these graduates who come out with great paying jobs, and I think these companies can be a lot larger.
Yeah.
And our third in that is black line safety, which makes hazardous gas detection systems. And this one does trade in Canada, and the symbol is BLN. And they have a great networked service that they offer along with these hazardous gas detection systems. So it's worker safety. So these are three of the new investments that we added last year that are supporting our theme of the infrastructure broadly defined.
Well,
but again, a new area for us.
That's cool. The 1 year return on Lincoln is like 50%.
Yeah, they invest and open new campuses, and then once the campus is open, you can imagine the incremental return is quite high from adding new students into the campus.
Yeah,
and adding new programs which fill up the campuses.
Right. And the campus is a good facility, but it's not a shipyard. So
that is true.
That's another good thing.
But boy, the shipyards need their graduates.
Yeah. All right. So it's time for our final question, John, and this has been a wonderful conversation. I've really enjoyed it. It's the same question for every guest, no matter what the topic, even if it's non-financial. If you've already said the answer, feel free to repeat it, but it's a simple question and it's for the benefit of our listener. If you could just leave them with one thought today, one final takeaway, what would you like it to be?
Yeah, I'm going to answer this with a couple of parts, but it's the same answer. The first is relating to what we discussed in knowing yourself as an investor. So part of that is taking care of yourself. And a great book that recently came out, Peter Attia wrote a book called Outlived. And it is goes through the 4 chronic horsemen of disease, which are cardiovascular, type 2 diabetes, Alzheimer's and dementia, and cancer, and the things that can be done through lifestyle, nutrition, and exercise to take care of oneself to ward them off. And so taking care of yourself and knowing yourself as an investor puts you in the best frame then to be a patient long-term investor and invest in things you know. So I would say take care of yourself, and in doing so, you're at the top of your game to be able to know what you own and research, and then be patient.
Excellent. I hope everyone listening to this does that. Thank you, John, for being here. It's really been a fun, exciting conversation full of lots of ideas and insights and names that you've thrown out and explained to us. I really appreciate you being here.
Great. Dan, thank you. Corey, thank you. A real pleasure.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.